Assalamu alaikum class. Today is lecture number 23 and we are going to discuss chapter number 13, that is relevant cost for decision making. First of all, what is relevant cost? It is that cost that differ between alternatives. It means if the price or cost of wheat is 25 rupees kg and against it the alternative is rice and it's only 20 rupees kg, then that is the cost relevance of substitutes. So if we want to define relevant cost, we can simply say costs that differ between alternatives. If we want to say that what is the basic difference between relevant cost and irrelevant cost. So the relevant cost have benefits that are critical for two reasons. Number one is irrelevant data can be ignored. It means decision making is based on only the normal cost. We will not include the relevant cost. So the first benefit is the irrelevant data will be ignored. The second benefit is that bad decisions can easily be ignored by analyzing alternatives, benefits, and irrelevant costs. So these are the benefits of relevant cost. To explain the relevant cost, we have term that is avoidable cost. It is that cost that can be eliminated as a whole or in part by choosing another alternative. The example of the avoidable cost is that instead of going to the movie to watch it, if we get DVD of the same movie on rent, it will save our time, it will save our cost, and definitely the cost margin between the going to the movie and to see on rent is definitely different. So our movie cost is avoidable cost by alternate DVD of movie on rent. So this is the avoidable cost. And we can say it is also a relevant cost. In comparison of irrelevant cost, unavoidable costs will be treated as irrelevant costs that cannot be avoided. The two categories that cannot be relevant in decision making, two categories of costs that can never be relevant in decisions, those irrelevant costs are sunk cost and future cost that cannot be differ between alternatives. As we studied earlier, what is a sunk cost and what is future cost, just to elaborate this, I'm explaining again. Sunk cost is a cost that has already been incurred and cannot be avoided. For example, if a car dealer purchased 5-year-old car, the amount of that car will be considered as sunk cost because it has already been incurred and the transaction cannot be undone. Then comes the future cost. If you remember that we pay some expenses in advance, like prepaid expenses that are called prepaid expenses, like if we are giving insurance cost in advance, it will become prepaid insurance. If we are giving any type of expenses in advance, it will become our future cost that cannot be replaced or cannot be get alternate because those costs are unavoidable. We cannot avoid those costs because we already prepaid it. So these two type of costs will not relate to the relevant cost. These costs will be called as irrelevant costs. Then there is concept of different cost for different purposes. In our managerial accounting concept, it is clear that costs that are relevant in one decision situation are not necessarily relevant in another. It means manager need different cost for different purposes, and the concept of different cost for different purposes we are going to discuss in our further topics. So let me give you an example of automobile related costs. By taking the automobile cost example, if we say that there are two types of method to calculate the costs. The first one is annual straight line depreciation on car. If we decide that we have 2800 rupees fixed depreciation on car, but if we want to use different cost for different purpose, we convert this 2800 fixed cost by using the method of per units of production method. By using 10,000 miles, our per mile depreciation will be calculated as 0.280. In the same way, the cost of gasoline will be based on 0.100 per mile. Our annual cost of auto insurance license is 13,380, but by using the different cost method, cost per mile method, our per mile or cost of auto insurance and license will be 0.380. In the same way, our maintenance and repair cost, if we say per mile 0.065 rupees cost will be incur. In the same way, the parking fee is 360, but if we divide this 360 into 10,000 miles, we will be able to get 0.36 per mile parking fee cost. So what will be the difference between these two? The total average cost per mile will be calculated as 0.619. If we use the method of units of production, we will get different amount. If we use the lump sum fixed cost expense amount, we will get the different result. So it is supporting that different costs are used for different purposes. Further explain this, if we say a person is willing to drive to another city, he have to calculate relevant financial costs of driving as well as relevant financial cost of traveling through train. So these are the different purposes, but the aim is same. So we will calculate the difference of cost between relevant costs. Gasoline, like he is traveling 460 miles, our gasoline rate was 0.100. The maintenance and repair cost will be 460 multiplied by 0.065. The depreciation cost of car will be 460 multiplied by 0.280, and cost of parking will be 0.460 multiplied by 0.036. And the ticket cost of ticket for train is 104 rupees. If we calculate the cost of driving, we will get 49, 29, 11.96, and the cost of parking, we cannot say that the parking cost will remain same. Like if we say the stay is of 2 days and per day parking fees 25, so we will get 50 rupees charges, so the total will become 137.86. Now if we do the comparison, the cost of driving for the aim is 137.86 and the cost of ticket of train for the same aim is 104 rupees. So these are the different costs for different purposes. The purpose is driving through car, the purpose is driving, our cost is 137, but the purpose is traveling and enjoying, the cost is 104. So different cost for different purposes. If you understood the concept of different cost for different purposes, now there comes reconciling the total and differential costs, or we can say differential approaches. Like if the company is calculating the cost, it's facing that the units produced and sold are 5,000 in the current situation, and in the situation of new machine the selling price per unit will remain same in both cases. The direct material cost per unit is 14, and in the same way for new machine is 14. Direct labor cost is 8 rupees in the current situation, and in case of new machine the direct labor cost is 5 rupees because the machine is new and the labor work is little bit less. Variable overhead per unit will be 2 rupees in both situation. Fixed costs others are 62,000, yani in easy words we can say the fixed expense is 62,000, so we will use 62,000 in both cases. But another fixed cost of rental of new machine is 3,000, that is extra cost. Now we are going to calculate the total and differential approaches by using this data. As we discussed that for the sales the units were 5,000 as I told earlier, and 40 rupees is the selling cost. In current situation, in situation of new machine, the differential costs and benefits. Our sales amount will remain the same in both cases. The difference is 0. The variable expenses direct material direct material cost was 8 rupees per unit, 14 rupees per unit. Direct material cost was 14 rupees per unit in both cases. So the amount is 70,000 and 70,000. For direct labor cost, the prices were, in case of current situation price was 8 rupees. In case of new situation the price declined and it became 5 rupees. So our amounts become 40,000 and 25,000. Their difference is 0, but there is a benefit, that is 15,000 rupees benefit. The variable overhead rate was 2 rupees in both cases, so 10,000 and 10,000. The difference is 0. Our total variable expenses are 120,000, 105,000. Now if we want to calculate the contribution margin, our value will be 2 lakh minus 120,000 will be 80,000. 2 lakh minus 105,000, our contribution margin amount is 95,000. Now if we deduct the fixed expenses, Others that were 62,000 and 62,000. Rent of new machine is 3,000. So our net operating income will be 18,000 in current situation, but in new machine situation our net operating income is 30,000 and the difference is 12,000. So this is the favorable situation, because by installation of new machine that is on rent, our revenue increase, our direct labor cost decrease, and our fixed expense is little bit high, but overall the net operating income is beneficial. So this is the beneficial situation and this is the beneficial situation, and the differences vary. Result give us benefit of 12,000 rupees more net operating income. Now if we say the net advantage, what is our net advantage of renting new machine? The decrease was in direct labor cost, that was of 3 rupees. We got 15,000 rupees benefit. The increase in fixed expense was 3,000. That was the rent of new machine. So we were able to get 12,000 rupees net annual cost saving from renting new machine. This was our benefit, 12,000 rupees. Let us explain the concept of adding and dropping product line and other segments. Here is the income statement of 3 product lines and their total impact. If we see in housewares product line, our net operating income or loss is 8,000. How we can improve this? How to deal with this type of cost? What type of additions and subtractions we can do to decrease our loss in the housewares? If you see that in housewares the sales are 50,000, the variable expenses are 30,000, our contribution margin we will get after deducting this is 20,000. Our fixed expenses are salaries, advertising, utilities, depreciation, fixtures, rent, insurance, journal administrative expenses. 8,000, 6,500, 1,000, 2,000, 4,000, 500, 6,000. Our total fixed expense become 28,000. And if we do we take the difference of contribution margin and total fixed expenses, our net operating loss is 8,000. How to deal with the loss of product line, that is houseware? If we show that what type of fixed expenses are avoidable and which of them are not avoidable. If we take the scenario expenses of housewares, like salaries are 8,000, it is an avoidable cost. How it can be avoidable? If our houseware line is retained or discontinued. We stop this type of product segment. Our advertisement expense is 6500. It is also avoidable if we discontinue this product line. But our utilities, depreciation, fixtures, rent are unavoidable. They cannot be avoided because they have to be paid in every condition. In the same way, our insurance cost is 500. As we are not continuing our houseware product line, so this 500 can also be avoided. Our general administrative expenses were 6000, so these are not avoidable because administrative expenses are already incurred. They are working in our organization. We cannot ignore them. So if we sum up these figures, so our not avoidable cost total is 13,000 and avoidable cost total is 15,000. If we take the difference of these, if we our contribution margin amount was 20,000 as reflected in our income statement, that our contribution margin amount was 20,000. In the house where the contribution margin amount was 20,000, and if we take that contribution margin amount is 20,000, and if we less the fixed expenses that can be avoidable amounting 15,000, as mentioned here the amount is 15,000 of avoidable cost, then our decrease in overall company net operating income will be 5,000. Here is a look of overall status. If we ignore the avoidable fixed expenses, our net operating loss will become 5,000 rupees, as it was 8,000 rupees earlier when we were unable to avoid the costs. But after eliminating the avoidable costs, our net operating income became 5,000 rupees. The loss declined with 3,000 rupees, as it was 8,000 when we didn't remove our unavoidable costs, because utilities, depreciation, rent, and general administrative expenses are unavoidable expenses that cannot be avoided. With the discontinuation, the advertising, the salaries, and the insurance discontinued, and we can easily avoid these type of costs. By avoiding these costs, our net operating loss declined to 5,000, as before it, when we were unable to remove the avoidable cost, the net operating loss was of housewares was 8,000.